If you're in a KiwiSaver default balanced fund right now earning 3.5% a year, you just became the person losing money to inflation. The Reserve Bank just signaled OCR cuts are coming. What that means in dollars and cents is this: your fund returns are about to compress even further. While inflation sits at 3.3%, you're barely protecting yourself. And your fund manager won't tell you there's a better move available. Here's the specific number that should concern you. A 40-year-old New Zealander with $95,000 in a KiwiSaver default balanced fund, earning that 3.5% per year, will have $242,000 by age 65. That's assuming 25 years and no additional contributions beyond the compulsory 3%. Now compare that to someone who took that same $95,000 and built a dividend-focused ASX portfolio earning 6.5% per year. They'd have $387,000 instead. That's a $145,000 difference. One choice. That much separation. But here's why most KiwiSaver members never see this comparison. The default balanced fund is designed to be simple, not optimal. It's designed to suit everyone, which means it suits no one perfectly. And when OCR cuts come, which the Reserve Bank just signaled they will, bond yields fall, which means the fixed income portion of your balanced fund produces even less income. ASX dividend stocks, on the other hand, often increase their payout when rates fall. The policy change that hurts your KiwiSaver helps your dividend portfolio. That's the insider secret your fund manager cannot tell you, because they manage bonds for you, not dividend stocks. Let me show you the maths that actually matters. The average Australian and New Zealand household has $68,000 in KiwiSaver. If that's earning 3.5%, you're making $2,380 per year in gains. After tax at 33%, the PIR for most KiwiSaver members, that's $1,594 per year, or $133 per month. Inflation at 3.3% on that $68,000 base is $2,244 per year. So you're losing $650 per year in purchasing power. Over 5 years, that's $3,250 gone. Over 25 years until retirement, that's $16,250 in silent erosion. Now here's what the same $68,000 does in a dividend portfolio. If you build a portfolio of ASX dividend stocks yielding 6.5% gross, you're making $4,420 per year. Even after tax at 37%, assuming some capital gains treatment and franking credits, that's closer to $3,100 per year, or $258 per month. You're ahead of inflation by $856 per year. Over 5 years, that's $4,280. Over 25 years, that's $21,400 in real wealth accumulation instead of silent loss. Pause. But here's the part nobody talks about. You don't have to choose. You don't have to abandon KiwiSaver entirely. You can stay in KiwiSaver because it comes with tax-free compounding and employer matching. But you can also build a parallel dividend strategy outside of KiwiSaver using your after-tax income. That's the framework we are going to walk through. Step 1. Stop treating KiwiSaver as your only investment vehicle. It's a tax-efficient vehicle, which is valuable. But it's not an optimal return vehicle if you're earning 3.5% and inflation is 3.3%. Keep contributing to KiwiSaver for the employer match and the tax benefits. That's free money and tax deferral. But don't let it be your entire equity strategy. Step 2. Open an investment account with a local NZ broker or an ASX broker and allocate $200 per month to a dividend-focused portfolio. Why $200 per month? Because at $200 per month over 25 years at 6.5% growth, you're putting in $60,000 and you're ending up with $147,000. That's $87,000 in pure growth. The same $200 per month in your KiwiSaver balanced fund at 3.5% gives you $60,000 in and $96,000 out. That's $36,000 in growth. You're gaining $51,000 in real wealth by making this choice. Step 3. Build the portfolio using stocks that currently yield 5% or higher. Right now, that includes CSL, Wesfarmers, Telstra, Fortescue Metals on the ASX. On the NZ side, Vector, Contact Energy, and Mercury. These aren't speculative stocks. These are dividend aristocrats with 20+ years of consistent payouts. You're not hunting for gains. You're harvesting yield. A $68,000 portfolio split evenly across 8 of these stocks gives you $8,500 per position, each paying you roughly $425 to $510 per year per position. That's $3,400 to $4,080 per year in total dividends, paid to you quarterly. You can reinvest those dividends or take them as income. Step 4. Set up automatic dividend reinvestment. If you reinvest those dividends at 6.5% compounding, that $68,000 becomes $180,000 over 20 years. If you leave it in a KiwiSaver balanced fund at 3.5%, it becomes $127,000. That's a $53,000 difference from one decision about how your dividends get treated. And this assumes you never add another dollar after the initial $68,000. Real people add more. Here's what to expect in real time. At 30 days, you'll have your first dividend payment in the account. Could be $150 to $300 depending on your portfolio size. You'll feel this. At 90 days, you'll have received dividends from 2 or 3 payment cycles. Your portfolio will have paid you $400 to $800. That's money that didn't come from your paycheck. It came from company profits being shared with you as a shareholder. At 365 days, if you started with $68,000 and reinvested every dividend, you're at roughly $72,500. Your KiwiSaver equivalent would be $70,400. It doesn't look dramatic yet. But look at year 5, your dividend portfolio is at $90,200. Your KiwiSaver is at $83,600. That's a $6,600 gap after 5 years. By year 15, it's $156,000 vs $127,000. By year 25, it's $287,000 vs $198,000. That's the compounding effect of 6.5% vs 3.5% over decades. But here's what stops most people. They think dividend stocks are riskier than KiwiSaver funds. They are not. A dividend stock is riskier than a bond. But a diversified portfolio of 8 dividend stocks is less volatile than a single technology stock and more stable than a growth fund. The difference is you can see your dividends. You get quarterly proof that you own real businesses making real profit. KiwiSaver feels safe because it's handled for you. But that safety is illusion when your return is 0.2% below inflation. The one thing to do before midnight tonight: open a broker account. It takes 20 minutes. NZ investors can use Hatch, Smart Shares, or NZX Invest. Australian residents can use Stake or the ASX website directly. Set up your login. Don't fund it yet. Just have it ready. Tomorrow, set up a $200 per month automatic transfer from your bank. By next week, you'll have your first $200 sitting in the account ready to buy dividend stocks. By next month, you'll have made your first purchase and you'll be in the game. The OCR cuts are coming. When they do, bond returns will fall further. Dividend yields might hold or rise as companies maintain payouts through rate cycles. You're about to see the real cost of being set and forget. The choice is yours. Stay in KiwiSaver and earn 3.5%, or build a parallel strategy and earn 6.5%. The math's already told you which one works.